Okay, reasons why Friars follows his system. We've already provided the three-step process. Here I'll provide my argument for why I follow it. The reason each step is there, and the reason none of them can be skipped. If you know the steps but not the reasons, you'll abandon the steps the first time the market makes you uncomfortable. Fry's included several, in fact quite a few, articles from academic journals and also from textbooks. They may be boring to some, but I really need them in there to explain the system in its context. Okay, the purpose of the presentation. First, I'll explain the procedure, justification, and the second part goes through the system's four-part template. So it's a lot of it's based on Munger's saying that isolated facts are useless. The same is true for isolated rules. Cover at 50% is a fact you can remember and still not obey. Hung on a theory why the second half of the profit is earned against worse odds than the first, and it becomes something you can defend at 3 a.m. when the position is going your way and you want to hang in to take more. So part one, influence. Where the idea comes from and who said it. Principle. What it asserts in one line. Why it works. And here's the theory and the evidence behind it. Peer-reviewed evidence. Where it sits, which step of the process it's governing. Always remember, a rule you cannot defend is a rule you will abandon under pressure. So now we come to the two traders that most influenced Friar from the start. Well, from when I was 29 and I got into this. Ed Secoda is a pioneer of computerized trend following. I was introduced, though unfortunately not personally, by a colleague who did know him personally. In fact, Greg was one of his turtles. He said you must read Secoda's interview in Schwager's Market Wizards book. And this is the origin of the mechanical discipline in Fry's system. The principle, the system is specified in advance, and it's executed without any renegotiation. Secoda is known for three particular quotes. His three rules. Rule number one, the elements of good trading, cutting losses. Rule number two, cutting losses. And rule number three, cutting losses. And if you can follow these three rules, you have a chance. Mechanical trading helps with that. Secoda's next quote I wanted to give you, and it really rings home with me. Systems don't need to be changed. The trick is for a trader to develop a system with which he is compatible. Okay? Fryer developed his algorithm to suit me, to be patient, long-dated, geopolitically driven positions, because that's what I know, that's what I am. Somebody else's scalping system would be abandoned within a fortnight, not because it's worse, because it just does not fit. This next one we'll need to have a think about. Everybody gets what they want out of the market. It's deliberately uncomfortable. If you keep taking trades that fail the algorithm, Ask what you are actually being paid. Excitement, usually. Sometimes the pleasure of having been right about the world, even though the position lost. Sometimes, this is the ugly one, the confirmation of a low opinion of oneself. Whatever the currency, the market will keep paying it, and it will keep charging you for the privilege. The mechanical system exists to close that side payment off. It's non-negotiable. That's why I use it. Okay, this slide covers a topic that some would dispute, and of course, me being a smart ass, I would welcome a debate on it. Mechanical beats clinical judgment. In 1954, Paul Mihiel, a clinical psychologist, set expert judgment against simple statistical formulas across a range of prediction tasks, and the formulas won or drew almost everywhere. The finding was so unwelcome that it was tested repeatedly for half a century. In 2000, Grove and colleagues meta-analysed 136 studies of it and confirmed the result. Mechanical prediction beat clinical prediction in about half the studies, drew in most of the others, and only rarely lost. Okay. Note what it is and what it is not saying. The expert's knowledge is not the problem. The formula is usually built out of the expert's own variables. What fails is the expert's consistency in combining them. I guess an everyday example, show a doctor the same case notes on a Tuesday and again a month later, and you will often get two different answers. The system does not replace what you know, it removes the day-to-day variation in how you apply it. The system is a pre-commitment device. Put simply, a system takes humans' knowledge and removes the human's inconsistency. Emotion as a systematic distortion. Prospect theory. People are risk-averse over gains and risk-seeking over losses. Thus, it's asked about for a trader. Let's say, think about it. You are up 40% on a spread. Risk aversion over gains say, take it now. Lock it in. Don't let it get away. But you are down 40% and the thesis is broken. Risk seeking over losses says, hold on, give it room. It'll come back because a certain loss is unbearable, but a gamble on avoiding that loss is not. Put those two together and you have a machine for cutting your winners and running your losers. It has a name in behavioral finance literature, the disposition effect. Sheffrin and Statman named it in 1985. Odeon tested it in 1998 on 10,000 real brokerage accounts and found it plainly. Investors sold winners at a marginally higher rate than losers, and the winners they sold went on to outperform the losers they kept. Okay, let's return to Sakota. Rule number 1, 2, and 3, cut losses. It's not advice about willpower. It's a rule written precisely because willpower is the thing that can fail. Remember, a rule that depends on you being calm enough to apply it is not a rule. Okay, this one is defensive and it's necessary. Everything so far has argued that a mechanical rule protects you from yourself. A skeptic can accept all of it and still ask whether the particular rule has an edge. Here's some evidence. Jagadish and Titman, 1993, established cross-sectional momentum in US equities. Moskowitz, Uy, and Pedersen 2012, documented time series momentum across 58 instruments in 4 asset classes. Hurst, Oy and Pedersen, 2017, extended trend following evidence back over a century. Where does this information sit? In step 2 of the system. Okay, Fry's read this book and listened to the audio book more times than I can remember. It's a great book, great story, a great book. So Jesse Livermore, Reminiscences of a Stock Operator, published in 1923 under Edwin Lefebvre's name. He was a journalist. Livermore is thinly disguised as Larry Livingston in the book. It's over 100 years old and still the best account of what it feels like to be right too early. Okay. So, lessons from Livermore. 1. Sitting. It never was my thinking that made the big money for me. It was always my sitting. Livermore is saying his analysis was never the scarce resource. His patience was. Next, the line of least resistance. Livermore didn't forecast. He waited for the market to reveal which way it wanted to go, and then he went with it. So Fry built this into the system by step 1, says how the situation ought to resolve. Step 2 waits for evidence that it is actually resolving. The fundamental view is a hypothesis about the future. The signal the algo gives is evidence about the present. And number 3, very important, being right is not enough. Livermore went broke 4 times. Not once was because of a wrong thesis. It was because he mismanaged positions. It's important, if one reads this book as a casualty report, one will learn. But if you read this book as a hero's tale, it'll bankrupt you. Okay, and 4th, and you need to think about it, reading the tape, remembering that he was around in the 1910s through to the 1920s. There was no screens to watch. There was ticker tape. For Livermore, this was never about prices alone. He was watching how much stock had to be sold to move the price a given distance, whether a decline meant bids or silence, whether a rally was accelerating or grinding. He was reading supply and demand through the flow. The next slide shows that others eventually caught up with him. Again, remember, he was reading a ticker tape. An important point about patience. I know I rabbit on about it a lot, but it's very important. Patience has a formal value. Waiting is not the absence of a decision, it's holding of a choice, and choices have values. McDonald and Siegel put a number on the value of waiting to invest in 1986. Dixit and Pindick built the textbook around it in 1994. The result is that under uncertainty, committing now destroys the choice to commit later on better information. And that destroyed choice is a real cost, which naive net present value analysis simply ignores. Every trade you take today because you were bored is a choice you have thrown away for nothing. Okay, a bit of a story. A famous baseball player, Ted Williams, in the US in the 1940s and 50s, very famous batter, divided the strike zone into 77 cells, and he knew his average for each one. He only swung at the ones where he hit well. Buffett added to this that the market, unlike baseball, calls no strikes. So you can stand there indefinitely and nothing bad happens. Okay? So Friar's system, we don't go looking for trades. We let the suitor ones find us. Importantly, tape reading is now a research literature. The through line, Livermore's method was vindicated by people who had never heard of him. Kyle, 1985, Gloston and Milligrom, 1985, built the models on how private information gets into prices through the order flow itself. An informed trader must trade to profit, and in trading reveals something's happening. Easley and O'Hara, 1987, showed why trade size carries information. Hasbrook, 1991, measured how much information a given trade contains. Bloom, Easley and O'Hara, 1994, proved formally that volume statistics carry information the price sequence alone does not. Remember, Livermore had no model, no data set to test on. He had a tape and 30 years of it and his brain, and he arrived at the right answer. The flow tells you something the price does not. That is the vindication. Important. The moment you accept the tape is a genuine information channel, you have to ask who's reading it. A man watching a screen at 4 in the afternoon is exactly the inconsistent trader Miel was writing about. So Friar keeps the information and replaces the reader with the algorithm. The tape read by rules and data, not by Friar's mood. Okay, this one might be controversial to some, but I'm using the data. Frequent trading destroys value. Barber and Odeon examined 66,465 US households between 1991 and 1996. The average household underperformed the market modestly. The most active quintile underperformed by roughly 6 percentage points a year net of costs. Gross returns were not very different. The damage was almost entirely the turnover, the amount of trades. Not what spread bet management wants to hear, but the truth is hard to accept at times. Their 2001 paper traced the excess turnover to overconfidence, with the sharper result that men traded around 45% more than women and underperformed them accordingly. So what it means is, I don't need to trade often is not a personality trait we are dressing up as a strategy. It's the single most reliably documented edge available to a private trader, and no payments are required to some dodgy YouTuber claiming to be a genius. Sizing to conviction has a formal basis. Pretty simply, number of contracts equals confidence in the system is the Kelly criterion in plain English. It says two things. Bet more when the edge is bigger, bet less when the outcome is more uncertain. And returning to Jesse Livermore, 4 bankruptcies, no wrong thesis. He was destroyed by size, not by analysis. Sizing is the discipline that stops a correct view from becoming a fatal position. Okay, now I'll explain why step 1 of the system exists in the form it does. Step 1 is about macroeconomics, political economy, trade balances, capital flows, central bank reaction functions, energy and commodity dependence, political risk, and numerous other things. This is a competitive advantage that Friar holds versus many punters, and it's the reason the process begins with fundamentals rather than with a screen. Most retail traders arrive at a geopolitical event holding a headline. Friar arrives holding a framework for what it does to the demand, to rates, to currencies, and to the particular firms exposed to them. For example, Friar spent more than 20 years teaching at universities in Thailand, China, Cambodia, and South Korea. So I was teaching supply chain reconfiguration in Korea, the Korean export cycle, Chinese policy transmission, ASEAN political economy were the syllabus, and also I had experience on the streets outside. The Anglo-American financial press covers that region and thinly, which is exactly where an informational edge can exist for a private trader who cannot compete on speed and data. Teaching is the test of understanding. A lecturer cannot hide behind a half-formed idea to students in most cases. The students I had, parents were paying chunky amounts. Many of the students were very intelligent and knew the more they studied, the more they understood, the better university they would be accepted in the US, the UK, or Australia for their graduate degrees. And that would provide for them the better salary. Obviously, the better university they go to for graduate, the higher salary they'll be starting on. So if the system cannot be explained in 3 steps, it is not yet a system. It's a habit with good intentions. Okay. So learning by teaching. When I was preparing teaching material and then teaching it, it produces deeper understanding and better retention than studying the same material by oneself. Baha and Schul demonstrated it in 1980. Fiorelli and Mayer refined it in 2013, showing that the gain comes chiefly from the act of explaining rather than from the mere expectation of having to explain. If you cannot explain it to an undergraduate, you don't understand it. And again, this is another reason why I write the articles or the posts I do and why I make these videos, because I learn from it. I learn for my own benefit, and I hope others can benefit too. Okay, intuitive expertise is real, but it requires 2 conditions. Stable cues genuinely relate to the outcomes, and rapid, unambiguous feedback so the cues can be learned. Chess has both. Anesthesiology has both. Firefighting has both. Financial markets have neither. The cues shift underneath you. What drove oil in 2022 is not what drives it now. And the feedback is slow, noisy, and frequently only partly true. The sound analysis loses money. The reckless punt is rewarded, and you cannot tell which was which for months. That is a low validity environment. And a low validity environment, confident institution is not expertise, it's simply a feeling. And then I'll get to the last study I'll talk about. Tetlock study, 20 years, roughly 28,000 forecasts, 284 experts, and expert political judgment barely beat chance, with the worst calibration belonging to the most confident and most specialised. The people who knew one big thing did worse than the punters who knew many small ones and held them loosely. So the training is not worthless. It's the source of everything valuable in step 1. But it must be rooted through a rule rather than through a feeling of certainty. The economist supplies the hypothesis. The algorithm supplies the verdict. Okay, well, for those of you that managed to sit through that, thank you. Well done. I'll finish up with just saying that's the history behind Friar's system. I'm 100% relaxed using it because I developed it. I did the hard work and it's paying off. Please note that Friar will make it clear on Discord when he's actually taking a trade. Nothing else said or shown indicates a trade. This way I know Friar's system is being watched by others, and thus that reinforces the results. Luckily, I really enjoy studying, though that only came when I was 29. Friar did not finish senior school. Good luck to all questions welcome, and any suggestions for topics you'd like me to present, let me know.